Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another double shot interview where we interview a CEO or a politician or someone we think is interesting and worth talking to. And today I've got Jonathan Ling with me, who's the Chief Executive of New Zealand's biggest listed company, Fletcher Building, and also a recently appointed Director of ASB Bank. Welcome, Jonathan, and thanks for coming in.
Thanks, Gareth.
Look, you're almost at the end of your financial year at Fletcher Building now. With the interim results back in February, you were saying that you'd seen a noticeable pickup in activity towards the end of last year. Has that continued through the last few months?
Certainly, we saw the activity pick up in about November, December last year. You might recall that in the trough of the recession, new housing was running at about 12,000 houses a year. It picked up to about 15,000, 16,000 houses a year, but really since that's continued into February and March, but since then it's really flattened off. And there are a lot of mixed signals out there at the moment. Hasn't dropped again, but it's actually not really improving at the moment either.
So what's your overall view on where things are headed with the housing market and the construction market, I guess both in New Zealand and Australia, which are your two main markets? Yeah,
I think in the residential sector, there's sort of a lot of mixed messages, as I mentioned earlier. Interest rates are starting to go up. Interestingly, house prices haven't really come down, and so affordability remains quite a significant issue. And I think what we're seeing across the company is New Zealanders starting to deleverage. You know, they're concerned about debt, and so while they've probably, in terms of in their pockets with tax cuts and previously lower interest rates, they're actually paying off debt rather than back in the markets spending money. So I think the recovery is going to be forward and upwards, but I think it will be reasonably slow and probably a bit wobbly at times.
So what does all this mean for Fletcher? I mean, how are your full year results looking? You obviously haven't come out with an update on your profit guidance, so you're still comfortable with what you were saying back in February? Yeah,
very much so. I think we're still comfortable with our guidance. I think sometimes we might have hoped for it to be a little better this time, but it hasn't been. And but I think, again, as we go forward into 2011, and that's where we're focused on at the moment, we're not going to see the sort of rapid recoveries that we might have seen in previous recessions.
So for the 2011 financial year, do you anticipate some earnings growth?
Yes, certainly. I think, but the earnings growth is probably more coming from, first of all, you've got to remember that the earlier part of the 2010 year was very quiet in the July through October period, so that'll give it a little bit of a boost. And the other side to it was we're still very active in cost reduction and our business transformation strategies, and I'd expect that will deliver some earnings growth next year as well.
Is there more to come on that front? More cost reduction? I mean, you've scaled back some of your plants, you've shut a few. I think there was one in Spain you were looking at, and one in Australia recently. Yeah. Is there more on that front to come?
You never say never on these things because it depends on the economic circumstances. But if things stay at this similar level, we've really moved beyond cost reduction. We're really now into what we're calling the business transformation strategies. That's looking at better ways of distributing product, getting logistics costs out, stopping multiple handling of product as it goes from our factories to a customer. And what we're finding at the moment is there's still a wealth of initiatives that we can implement over the next few years. And I think not so much cost reduction, but in the sense of redundancies and closing factories, but cost reduction in the sense of reducing our logistics costs, more effective customer service, better ways of getting information to our customers. That will deliver a wave of earnings improvement over the next few years, and will probably be the primary source of earnings improvement.
Okay, and in terms of, I guess, looking for areas where there might be some growth domestically, the government's come out with a leaky homes package. Now, do you see any material impact for Fletcher? Obviously, there's billions of dollars worth of work that needs to be done. Obviously, you guys are big insulation and plasterboard makers. So what's your take on that?
Yeah, I think now that we've got to confirm the details of it, and the government's been very consultative in terms of some of the implementation and governance issues around the program. And there are issues like if the consumer actually signs off that they won't sue or they waive their right to claim further against councils, who's going to provide the warranty on the actual work that's actually put in place? So on the one hand, we've got warranty issues around the leakiness now, but what happens if there's leakiness after it's been repaired. And so there's a whole lot of implementation issues still to sort out. But generally speaking, the program will be very positive for Fletcher Building, particularly in the supply of plasterboard, insulation, timber frames, which will be the one of the key areas of work. So from that point of view, I think it's very good. And I think we have learnt, and I'm hoping the New Zealand government has learnt from the practice of, say, the Australian installation program, where governance wasn't good, and the net benefit of the whole program was a disaster. On the other hand, I think there's an opportunity here for this program to be very good for New Zealand householders, very good for Fletcher Building, and very good for the building industry.
I know some of the analysts have done some number crunching on what it might mean for Fletcher. Have you done any of that internally? We
have done a little bit of that internally, but I think it's really a little bit too early to really get the full impact, because of course the real issue is at what speed will these repairs get done.
It's probably not going to be quick, is it?
Well, I think the reality is that it's going to be somewhere between a 5 and a 15-year program, and we're just not sure exactly what that means. There are other issues too. So, for example, the building codes have actually changed since the leaky houses were built. And are the repairs going to be to the new building codes versus the old building codes? Because if they're to the new building codes, then of course the repairs are going to be much more extensive than if they were to the old building codes, or if indeed there is an interim code that covers just the repair work.
Okay, now one of the other issues people are always interested with regarding Fletcher is acquisitions. You're always obviously linked to possibilities on that front, given your strong balance sheet and focus on growth. Have you been looking at any potential acquisitions in recent times?
We're always looking at a raft of things, and there's always a raft of opportunities that start to emerge. I must say the activity levels in mergers and acquisitions has been very low over the last couple of years, and that's particularly because companies under stress have found it fairly easy, or sizable companies under stress, have found it very easy to both raise equity and refinance, more so than any other recession. So that means is that vendors' price expectations have stayed relatively high. We'll always stay on the lookout. We do have a very strong balance sheet, but we won't overpay for a possibility. And so it's fair to say, I think, at the moment that there's really not that much around.
So are there any that you've actually had a reasonable look at of late and decided not to progress with?
We haven't had one where we've decided not to progress, but we have there's probably a dozen possibilities in Australia and New Zealand that we're always looking at and keep a watching brief on, and we have plans ready to go if opportunities arise, but none of those are active at this point.
I think one of the areas that's been talked about of late is the cement and aggregate series in Australia, and a company by the name of Adelaide Brighton, I think. Is that one that's been of any interest, or that area?
Adelaide, the cement area is of interest to us. Adelaide Brighton would be of interest to us, but they've got a very stable shareholding at the moment. The Barrows in particular own about 22 or 23%, and the future of Adelaide Brighton, from a point of view of us, really depends on what they want to do. And at the moment, it's just not available. So.
Obviously, the last really big company you bought was Mycap. You obviously had a few issues with that. How are things looking with Mycap now, especially in that tough North American and US market?
Well, it's still pretty tough, I must say. Having said that, for this year, Mycap are a little ahead of the recovery plan that we put forward this time last year. So they've done a terrific job in a very, very difficult market. On balance, Asia continues to go very well, and we're